Hello, good morning and welcome to this edition of the newspaper show right here on ET Now. I'm Cheryl D'Souza. I'll take you to the top headlines as there in the Economic Times as well as the Times of India. So let's get going with the top 10 headlines as there in the Economic Times this morning. And first up, Reliance Industries to bear 19,000 crore rupees of future group liabilities. You have GST Compensation Fund can stay beyond 5 years is the word coming in from the Attorney General. States may reject centre's borrowing options. Yes Bank tightens news around Naresh Goyal. Suzuki-Toyota alliance to step up MUV play. Banks asked to refund fee on UPI payments. Paytm Mall breach reported, company denies. TikTok assets can't be sold without China nod. Government shouldn't be running airports is the word coming from Puri. And Mumbai seeing increase in COVID-19 cases. All right, and those are the top 10 headlines that's there in the Economic Times. So let me run you through top market headlines that's there in the newspaper. Foreign funds pour into India and emerging markets. You have retail investors, HNIs play role in the market rally. Reliance retail to be 7 times its closest rival. Future buyout to add more steam to Reliance Industries stock, and Rupee betters rank among Asian peers. And from market headlines, moving on to the corporate headlines is there in the newspaper, and that is still locked. Cinemas feel frustrated. SBI may invoke Punj's personal guarantees. IT firms take a virtual onboarding. Festivals fail to light up phone sellers. And lastly, Tata Motors Hyundai win EESL's order for EVs. All right, those are the top headlines that's there in the Economic Times for you. But let's get going with the top story that's there in the paper. And first up, here you go. This is the top story that's there. And that is GST Compensation Fund says can stay beyond 5 years is the word coming in from Attorney General. The Goods and Service Tax Compensation Fund can continue beyond the 5-year transition period if a steep fall in revenue from the levy means there isn't enough money to meet the commitment to the states, the Attorney General has said in an opinion. To talk more on this, I'm joined by my colleague Ruchi to take us through what is happening in the GST issue with states versus centre. Ruchi?
The fight is not over. In fact, it has just begun. States like West Bengal, Kerala as well as Punjab have rejected the 2 options that have been given to them by the centre to make up for the GST compensation shortfall. In fact, the West Bengal Finance Minister calling it an act of fraud, while the Punjab Finance Minister saying that both options are unattractive. In fact, the Kerala Finance Minister told ET Now that all the opposition states will now be meeting on Monday to decide a way forward. We're given to understand that states had completely rejected these 2 options based on the fact that this will only increase their own debt servicing liability, and the centre is reneging on their promise. Remember, the centre 2 days ago had written to the states, assured them that the Finance Secretary as well as the Expenditure Secretary will be addressing all the issues and concerns of various states. In fact, as a part of option 1, they had said a special window will be made available by the central bank, by the RBI, to make up for the GST compensation shortfall on account of the implementation of GST of about 97,000 crore rupees. However, the second option is where the problem is, which is even though states go in for the second option, almost 2.35 lakh crore rupees they will be getting, which is a shortfall on account of implementation of GST as well as COVID-19. However, one cannot ignore the fact that states themselves will have to bear the interest burden. If they choose the first option, that means lesser money that they'll get. If they choose the second option, which means states will themselves have to pay for the interest burden. In both the options, states are not okay with what is coming their way, and which is why the battle is only going to be longer.
Thank you, Ruchi, for taking us through the details. And the most awaited deal has finally got inked. The Reliance and Future Enterprises deal got sealed at 24,713 crore rupees on Saturday. And my colleague Karunya is here to take us through all the details. Good morning, Karunya, and take it away.
We touted as one of the most historic deals within the Indian retail space. We finally have some clarity and an official announcement from Future Group and Reliance Retail. Talking about the deal contours and the math associated with it, first up, what we understand is that Future Enterprises at its board meet on Saturday consolidated all of its listed entities: Future Retail, Future Lifestyle, Future Consumer, Future Market Networks and Future Supply Chain. So all of these have been brought under Future Enterprise Limited via share swap deal of the various entities. This essentially is on the basis of the closing market cap that we saw on Friday, and it does not factor in the debt which will also be acquired. So that's something that investors and market watchers need to be careful about and digest eventually when the markets open. But yeah, as far as the deal is concerned, Reliance Retail will be buying the retail and wholesale business and the logistics and warehousing business from Future Group. This will be on a slump sale basis for a total consideration of 24,713 crores. FEL by way of slump sale will be hiving off retail and wholesale business to Reliance Retail and Fashion Limited. This includes key formats like Big Bazaar, Easy Day, Food Hall, Central, Brand Factory, etc. And Future Enterprises will also be selling off the logistics and warehousing business, like I said, to the holding company, which is Reliance Retail Ventures. Now, Reliance Retail will be taking on certain borrowings and current liabilities related to the business and discharge the balance consideration by way of cash. What stays back with Future Enterprises? Post the transaction, FEL will house essentially the manufacturing and distribution business of the FMCG goods and the integrated fashion sourcing as well as manufacturing business. Not only that, but they will also retain the insurance JVs that they have with Generali as well as with NTC Mills. Now, interestingly, Reliance Retail is also said to buy stake in the remaining entity. They will be, as part of this transaction, investing 1,200 crores in preferential issue of shares in Future Enterprises, which is the residual entity, for additional stake of 6.09%. They will also invest 400 crores in warrants convertible into equity shares for an additional 7.05% stake. So essentially, by the time the deal is over, Reliance could own anywhere between 6.09% to 13.14% of FEL, depending on additional contribution to warrants. So this is what the deal looks like, and what we can understand is in the near term, it will not be the owner of Future Enterprises, and Future Enterprises will have to use the proceeds from the transaction that we talked about in order to settle their liabilities. This comes as a huge relief for Kishore Biyani, who's been grappling with debt-related stress for many quarters now. They have a loan worth 15,000 crores to banks. Promoter pledge, of course, is not made public, but it's close to 7,000 odd crore rupees. So definitely good news coming in for their lenders as well. And for Reliance, they have a huge ecosystem to work with, which Kishore Biyani has created over the last many decades. They have access to 18,000 stores across the country, an ecosystem and very strong synergies to work with.
Thank you for that detailed analysis and the detailed report on the RIL and the Future Enterprises deal. Let's shift focus and let's talk about foreign investors. That's the story here, that they have pumped in money into India and emerging markets, and foreign investors are pumping money into Indian equities with renewed vigor. And why is the reason for that, and how much have they pumped in? I'm joined by my colleague Jayesh to take us through the details. Good morning, Jayesh, and take us through the story that's there in the Economic Times.
So what they have actually done is FIs have actually looked at India on an attractive basis and have started pumping in a lot of money into the country as well. Because if you have a look at the August number as well, that stands at nearly $6.5 billion for the month itself, which is, the highest monthly FII inflow that we have seen in more than 10 years now. So that's a big number that we are tracking. For the week itself, last week, they actually pumped in about $800 million. And for this year itself, it is more than $5 billion that they have pumped into India. Now, the interesting bit is that, rest of the countries in the world, they have actually seen outflows. So essentially, it means that, they are liquidating assets from other countries and creating more assets in India, so which is looked at as a positive manner as well. Not only August, but if you have a look at the trend in the last few months, they have gradually been increasing their inflow number into India. August stood at about $6.5 billion, while July was more than $1 billion, and June also they had about $3 billion, while May they contributed about $2 billion in terms of net inflow into Indian equities. So definitely on the positive side, and looking attractive from the FII point of view.
All right, thank you, Jayesh, for taking us through the details of that. And another story that's there in the Economic Times, the study and work from home may light up festive online sales. New users and product launches likely to drive the growth. To talk more on this, I'm joined by my colleague Winnie. Winnie, good morning. And looks like the sales may increase due to festive season, due to work from home, as well as study from home.
With people sitting at home, there's a lot of demand for electronic products, smartphones, the accessories which we use. So they are expecting to see an increase in sales of around 30%. So that's a really huge number that we're expecting to see in terms of increase in terms of sales. So, we'll clearly watch out for the online sales for especially mobile phones, smartphones, electronic accessories, appliances is what has been the trend we are seeing, and they expect it to continue as well. Now, what are we expecting in terms of GMV for this festive season? Last year it was $4.8 billion. That's in 2019. Now this year we're expecting around $6 billion to $6.25 billion in terms of sales. So surely we'll keep an eye out on that in terms of e-commerce sales, online sales. Also, companies have realized, brands have realized that people are focusing in small town a bit more, and the rural recovery, the small town recovery is much faster than urban recovery, and that trend was even noticed by companies during the August 15th sale, that's the Independence Day sale, when they saw this trend. So they are going to be focusing on products which are less valued, and that will really help them increase their sales in small town as well. So that is what even the both companies' co-founder Amit Gupta did mention. So surely we'll keep an eye out for that. And they also are saying that new entrants who are specifically on online platforms only will be also driving the demand of this e-commerce sales. So surely that is going to be a very positive sign over there for new entrants as well. And obviously they are planning to focus on, like I mentioned, smartphones will be of less than 6,000, will be something which will be more in focus, because small towns will be focusing on lower price value products as well. There's a lot of pent up demand which is driving the sales, as well as new categories are also getting involved in here. So that will be something we'll surely watch out for. And companies are increasing and spreading their supply chain distribution categories and logistic capabilities. So surely we'll watch out for the sale this festive season.
Absolutely, Winnie, like you said, let's watch out how the sales are in the festive season. Also, there's another quote coming in from Nestle, that's Suresh Narayanan of Nestle, saying that India's economy is showing signs of recovering after the initial impact of COVID-19. Some sectors were impacted more than the others. With easing of restrictions on economic activities, businesses are slowly getting back on track. The government has also announced several measures to ensure business continuity and sectoral revival. That is the word coming in from Suresh Narayanan of Nestle. All right, moving on then. CBDT has asked banks to refund the fee charged on UPI payments this year. This is the story here that's there in the paper. And what is CBDT saying? They've asked banks to return to customers and merchants any fees levied for making UPI transactions in 2020, adding that such charges violate the law. The lenders were asked to stop all such impositions or face penal actions in a circular issued on Sunday. So there you go. CBDT has directed the banks to stop levying UPI charges or face penal actions. No MDR fees applicable on digital payments on or after January 1st, 2020. So if you see the bank charges, you had ICICI Bank, you had HDFC Bank, as well as Axis and Kotak had introduced the charges. The customers were charged between 2.5 to 5 rupees for UPI transactions beyond 20. Banks are saying that such a move was necessitated due to increased load on servers during the lockdown. The NPCI pegged industry loss are up to 2,000 crore rupees for FY21, but CBDT has come out asking the banks to refund the fee charged on UPI this year. Let's move on to another story now that's there in the page 1 of Times of India. And here you go. This is the story, and that is Maharashtra to ease curbs on hotels, travel, government office attendance. The gyms could open within a week, is as per the Times of India. Hotels can enhance occupancy from 33% to 50%. You have attendance requirement in government offices for IAS officer level staff raised to 100%, 30% from 15% for the subordinate staff. You have more local trains to ferry for the essential staff as well. Students of 9 to 12 can visit schools to clear doubts on a voluntary basis from September 21st, and permission for opening up gyms is expected in a week. So there you go. You're going to have Maharashtra also to come out and ease curbs on hotels, travel, as well as government office attendance. Let's shift focus now on to the top 5 headlines as there in the in the Times of India for you. And first up, like I mentioned, Maharashtra to ease curbs on hotels and travels. You have India first to record over 80,000 cases in a day. Prime Minister Narendra Modi bats for domestic toy industry. All RPG sales staff can now work from home permanently. And India wins Chess Olympiad gold. All right, and those are the headlines as there in the Times of India. With that, it's a wrap on this edition of the newspaper show. Thank you for watching.